following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is the program for busy financial advisors and asset managers who are interested in finding ways to incorporate options into their clients' portfolios. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network. And we have a bit of a truncated panel for you today. It seems like with the holidays approaching and everyone running around trying to get a lot of things finished before these holidays engulf us, it's hard to get everyone on the same schedule for the program. But we were fortunate enough to get our good buddy and our good partner here on this program from the beginning, good old Mike Cavanaugh, the principal over there at RCM Wealth Advisors. Mr. Cavanaugh, welcome back to the program, sir.
It is great to be here on this cold, wet November day.
Yes, it is lovely, scenic, typical Chicago November weather this year.
The Miami of the Midwest.
Well, lately you certainly could have said that because we were hitting the 70s in January and February. We'll see if we can pull that off again for the third year in a row. That would be nice.
It would be nice. It would be.
All right, and with the weather report concluded, we're going to dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to Options 101. As the name implies, this is, of course, the portion of the program where we walk you, the very busy financial advisor and asset manager, through some basic options concepts that you could easily and with a little bit of perseverance and a little bit of effort on your part, really implement into your clients' portfolios and see a lot of dramatic benefit and impact from. And as we were looking over and discussing what to talk about on today's program, we went through the litany of different topics that we've discussed here on this program, things like volatility and things like collars and writing puts to get into stock positions and covered calls to generate income from stock positions. And even recently we did stock repair, which is a great way to really, if you have a stock that's taking a bit of a drawdown, use a stock repair and help bring it back to parity in a much faster fashion. So we talked about a lot of interesting ways to use options in conjunction with stock here on the show. So we thought, what better topic to take upon us today than to dive into and maybe go a little bit past what we talked about before and say, forget about using the options with the stock. What about using options in lieu of stock? So completely swapping out the stock in your portfolio using options. And before you get worried and before you say, wow, that's crazy, that's risky, let us walk you through a few examples of this and how it might benefit you and your clients. Now, what we're talking about here is really a very, very basic option strategy. It's known as the stock replacement strategy, and it's surprisingly effective. Now, Mike, I'm sure you guys over there with all of your myriad different clients at RCM probably employ this strategy on a regular basis. Am I right?
Well, ever since we changed the name of our firm from Know Your Options to RCM, nobody knows their options anymore. No, I'm just kidding.
They've lost all of that knowledge.
Yeah, and the stock replacement strategy is it's commonly used. What I'll say, I shouldn't say it's commonly used. We see the best usage of it when somebody wants to outlay a little less risk in any particular name. But some of the more creative and more useful ways I've seen stock replacements work is when they want to outlay about the same amount of capital, where they have focus on a sector or a certain industry, and they want to buy 5 names, and rather than, let's say they have $100,000 to buy in stock, the stock replacement, if they go, and buy an 80 delta call in the money, they're replacing the stock with an option, and they can buy, let's say that 80 delta call costs $20,000. They can buy 5 names for the price of one that they're paying. Now they do get less exposure, from a delta perspective, but they're not just betting on one stock. So that's kind of the more creative stuff that we've seen. And that's mostly coming out of people that have a lot of experience that understand the nature and usage of options. But it's not that difficult to replicate, and it makes sense.
Yeah, that's an ideal use case for this strategy. I mean, that's essentially one of the perfect scenarios you might want to employ the stock replacement in. So let's go a little further then and even walk our listeners through exactly what you're talking about. You kind of hit on the salient points there. Mr. Kavanaugh, Mr. C, maybe I'll call you for this episode. But there are a lot of other points to hit on as well. As Mike said, when you're talking about stock replacement, you're talking about swapping stock in your portfolio with a call option. Now, when you're buying stock, remember, you're kind of limited in the leverage you can employ there. You can buy the stock outright and pay for all of it, or as more commonly is used, you can use the 50% margin. That's pretty much the best you can do when you're talking about buying stock straight up. So your capital efficiency is pretty much limited at the outset. You know exactly pretty much as good as you can do. Now, with options, it's a different story. Like in that scenario Mike just outlined where he had $100,000 to buy a bunch of stock. You can spend all of that on pretty much one underlying. Now, what about if instead you say, wait a minute, I want to have bullish exposure to this underlying for a set period? What are some other ways that I could do that? And of course, we've walked through a lot of other ways on the show that you could express bullish positions. But now we're talking about getting really, really deep into the bullish sector where you want to have a lot of delta or directional exposure to the underlying. Remember, if you're confused about the Greeks, I encourage you to go back to our early episodes where we walk you through the definitions of all the Greeks. We're going to be focusing on delta a lot here today. That is, of course, the change in the rate of the option's price as the underlying moves. The higher the delta, obviously, the closer it is in corresponding price movement to the underlying stock itself. A delta of 100 essentially being synonymous with stock. So you're trying to put on a position there that is as close to a delta of 100 as you can get. Obviously, we talked about before about the at-the-money deltas for all of these names being 50, so you're going to have to go below the at-the-money strike to get a higher delta than just 50. You're going to have to keep going down. Remember, the farther down you go on the option chain, the more in the money those calls are and the higher delta that they bring to the table. So as Mike alluded to, a delta of 80 is probably a good starting point. A delta of 100 is probably going to be pretty expensive. But so in this scenario, let's say like the scenario Mike outlined where you're looking at a 5 different stocks. So maybe let's even boil it down to everyone's favorite, XYZ. You have XYZ stock you're going to buy, is trading at $100. And you could buy, let's say you want to buy 100 shares. And now you're talking about $10,000 to get into this stock. And so quickly, your faced with that, or even outlaying $5,000 to buy it on margin. Now you said, wait a minute, what if I look at these 80 delta calls and I can buy, let's say, an 80 delta call 6 months out, and it's only going to cost me the equivalent of $2,000. That might be an effective strategy now, because now you can take that, buy that position. You have what is essentially an 80 delta call. So it's going to move. Essentially, every time the underlying moves $1, that stock is going to give you about 80 cents of that movement, 80% of that movement. And as if the underlying rallies, that delta is going to increase. You're going to gain more of that benefit. So now all of a sudden you have a position that is very, very close to what you would have had with buying the underlying stock. And now you saved $8,000 off buying it outright and $3,000 off buying the underlying on margin. Now that is, you suddenly overcome that opportunity cost you had from buying that underlying outright. Now you have a lot more money you could put to work in other facets of your portfolio, like in the example Mike outlined, where you want to perhaps buy multiple names in a particular sector to give yourself broad exposure. That is an ideal way that you can go about that.
Yeah, I mean, there's very classic uses. I mean, I always try to think of let's make smart financial decisions with options, and let's not turn on the television and listen to what the screaming talking heads are talking about how to use options. It's always good to do a comparison. So what are the advantages of owning the stock? And then there's a cost benefit. There's never, it's better to do the stock replacement. It's better if it fits what you're looking to accomplish, but there's always going to be a cost to that. So if you look at it as if you own the stock, and let's use our favorite stock that's ever existed, XYZ. Let's say it's trading at $50. Let's say it's paying a 4% dividend. If you own 2,000 shares of this stock, you're going to get the dividend. It's $100,000, so the 4% dividend, you're going to get $4,000 a year in the dividend. You get the upside and downside risk of the stock. Well, maybe that's not what you want to do. Maybe you want a little bit more protection. Maybe you don't want to cap your upside. A stock replacement strategy in that scenario where you want limited downside, the most frequent use of the stock replacement in that scenario is a small shift from owning the stock to owning the debt on that company. So in this instance, let's say a 20-year note or a 20-year bond on that company is paying about the same, 4% coupon. And then you take what your 4% coupon would pay, and instead of buying stock or buying puts, you buy calls in the form of stock replacement. So you're getting the coupon for buying the bonds. You buy whatever the coupon rate is as a stock replacement by buying an in-the-money call. So now you've kind of created your own structured product. You've got a stock replacement strategy that pays for itself by the coupon that you're getting from the bond, and you still have upside in the stock if it goes up. It's limiting your downside, so you now don't have that binary risk of you're not collecting the dividend, so that's your trade-off, but you're getting the coupon on the bond, and you're going to have less upside, but you still have some upside on the stock. And that stock replacement strategy, a lot of banks and iBanks out there call that a market-linked CD. You can call it whatever you want, but it's one of the most popular kind of stock replacement strategies on an individual name that I've seen. Now, you can get even more and more creative. You know, the points I touched on before, you can take that $4,000. You can use some of the future coupons. You can say, instead of just being in XYZ, I want to be in 1, 2, 3. I want to be in 5 different stocks. So I'll break that $4,000 into 5 $800 increments and buy different call options in those. And now I've got a blended market-linked CD. So I think a lot of times, the products in the financial services world are made to be intentionally confusing when it's pretty simple to understand when you break it down. But as far as and these are great tools as a wealth advisor. The show's called Advisor's Option. If you take the time to understand this, one of the best trades I've made in my life for my clients was in 2008. It was an exact trade just like this. GE bonds got beat down to about 70 cents on the dollar after in the fall, back in the crash of 2008. They were still paying a 5, I think it was about 5.875% dividend, a 15-year maturity. So you could buy for 70 cents on the dollar, a bond that didn't get called away for another 15 years for a discount. And it never missed a payment. And with that extra money, so to speak, that for the coupon, I bought some call options. And, with time, I mean, that yielded an unbelievable return, because in about a year and a half, when things looked like we were still going to be a country and everything was fine, that GE bond went back to about 105. So we collected everything from the discount we purchased it at, and the stock went from 6 back up to 14. So tactically understanding how to use the stock replacement strategy, especially in this environment with baby boomers being the largest cross section of investors, and the over period of all investment history, the longest any generation has been invested in anything. They're looking for yield. And there's not a ton of yield out there. So if you can find a way to blend yield with upside, these are nice products, to make on your own, and nice strategies to use without adding risk. It's not a speculative tool. You just need to understand what the cost benefit is. If the stock goes down in the scenario where you buy the corporate bond and you're using the money that you get from the coupon, the 4%, to purchase the call option, and the stock goes down below your strike price at expiration, you're going to lose all the money that you spent on that call. You might have some bond risk fluctuating, but as long as the company's AAA rated, and it's a big name, you're going to address a lot of that equity risk by being in a senior note. So it's a risk transfer. If the stock goes up 100% in a year, you're not going to catch all the upside in that scenario, but you're going to take less risk. So it is a great strategy to use. We see people get creative with it. And like the bigger banks don't share that, because they make a lot of money on the fees for selling these products when they're not that difficult to understand.
I'm glad you mentioned that, because I think if there's one thing we could really hope to help people with on this show, it is just getting through that just fog, that wall they put up there of confusing terms, arcane terminology, making things seem far more complicated and far more obtuse than they actually are, because then you need to pay them. And so to execute these very elaborate strategies on your behalf. So something like we're talking about today, it is actually a very simple strategy to implement, and you could use it in so many interesting and exciting ways. The way you outlined is a perfect use case for this type of strategy, and how you could use it in combination with the stock. We could even take it back a step and say an even simpler way to implement this for a lot of our listeners and their clients is an example where, let's say, everyone's favorite these days, Apple, very pricey premium name stock, Amazon, Google, Priceline, all the names that I'm sure your clients are really hammering to you to want to buy, that are extremely expensive, will require significant allocations from their portfolios in order to buy that underlying. This is an ideal way to enter those types of names at a much more capital efficient type of way to do it. So we're talking about using these 80 delta calls. It's a perfect tool for those very, very expensive, high flying names that you still want to be a part of, but you just don't want to outlay all of that capital to buy the underlying. Again, stock replacement, a fantastic tool in that scenario. And that's just one of the many tools. We talked about getting sector exposure, using the market link CDs, so many great ways you can utilize this really, really simple and basic tool. Again, options, people have this perception options are extremely complicated, extremely risky. If you don't know what you're doing, you'll be destroyed, and that they take us many, many years to understand. Concepts like this are relatively straightforward. And if you have an understanding of basic risk management and some of these concepts we talked about on the show in the past, the basic options concepts like the Greeks and others, you can readily wrap your head around these concepts and use them to great effect for your clients. Now, I mentioned the Greeks. One of the other benefits of doing a strategy like this is something that Mike alluded to, is that it does reduce your downside. And how does that do that? Well, remember, if you're buying stock, you're buying essentially a 100 delta option. This stock moves 1-to-1 with the price of stock because, hey, it's stock. Now, options, you're buying an 80 delta option. Remember, we talked about how that moves only 80% of the amount that the underlying moves. Well, guess what? If the underlying drops, which is the worst case scenario in any position where you're buying stock or using a stock replacement strategy, that delta is going to decrease as the underlying drops. So your rate at which you're losing money is going to decrease as the underlying continues to fall. You'll still lose money, of course, but you'll be losing less. Whereas the stock, you're going to continue to lose money 1-to-1 as that underlying drops. So that's another reason, in addition to the overwhelming capital efficiency, that you may want to consider utilizing a stock replacement strategy. Of course, not everything is great. Not everything is free. There's no free lunch in the options market. There are a few downsides. Mike alluded to a few. The most obvious one that a lot of people see when they first come to this strategy is that, hey, there's an expiration date on this, and that's pretty much the same argument you can make for all option strategies. You have a very finite time period in which your strategy has to be successful in order for it to work out. And that strategy I outlined, that hypothetical example earlier of XYZ, we talked about buying a stock for $10,000 or on margin for $5,000, or buying it at a 6-month call for $2,000. Now, let's say in that scenario, the underlying XYZ kind of just sits still and does nothing for the next 6 months or drops a little bit. Guess what? You're going to lose pretty much all of that $2,000 or a substantial portion of it. So if you're in this scenario and you're using this strategy, you have to wrap your head around that and know what your ultimate risk is. Now, it's going to be less than buying the underlying, because the underlying can keep dropping, whereas the call, you're just going to lose the premium you pay for that call. But it's something you need to be aware of. Of course, because you're using such a small portion of your capital pool, if that does occur, let's say you do, worst case scenario, lose all that $2,000. You don't use any sort of risk management or stop yourself out along the way. You continue to lose that money, so it's all gone. 6 months and a day from now, you could put on a similar strategy again for somewhere around another $2,000, or maybe more, maybe less, depending on how you structure it, and then take another bite of that apple, and you still have a significant amount of capital left over. So that's one of the downsides, but also one of the potential upsides to this strategy, is that you have to understand what your risk is when you're going into it, and of course it has to be right by a certain amount of time. Now, Mike's example was awesome of the market link CD. Another way that I like to really utilize this strategy is another way to enhance a very, very simple strategy that a lot of advisors love. Advisors are always looking for income with a lot of the names that they're trading. And covered call is the number one tool for doing that across the entire advisor spectrum. So you're out there, you're an advisor, you're writing covered calls on behalf of your clients. Everything is working very well. You're loving it. Now you want to try to maybe tweak those returns a little bit and add a little bit more capital efficiency and a little bit more bang to the buck for your return here for your clients. This is a perfect scenario where now you can think about swapping this stock replacement strategy in for the underlying component of your covered call strategy. So now, instead of buying XYZ and then writing front month or even weekly calls against it, you can go out and buy a 6-month or a 1-year call on XYZ, an in-the-money call, and then write near-term options against it. Now, why would you do that? Well, for all of the reasons we just outlined. The methodology, the reasons behind it are all the same. Capital efficiency, the Greeks, again, remember, you're adding a delta component, which is going to decrease, so you'll lose less money as the underlying drops. Also, remember, you're also adding an option which has volatility. So now you have a Vega component to your portfolio as well. Again, as the underlying drops, the volatility will traditionally increase. And when that happens, that will, again, help to offset the rate at which you're losing money. You're not going to make money, but you're going to lose less money, which is another beneficial thing. So capital efficiency, better downside risk profile, and it's just a much more effective way to utilize your covered call. Now you have capital that's freed up you can use for other strategies or in other types of things for your clients, or even park it in cash and say, hey, I'm getting this is my return here. I only have a limited amount of capital tied up, and the rest is parked in very, 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 very risk-averse, risk-neutral CDs or in money markets or whatever your choice is for your clients. So there's a lot of great ways that you can utilize this strategy and juice it up. Mr. Kavanaugh, is that something you guys ever utilize over there? That kind of long-term, let's say, leap, and then writing the near terms against it. It's kind of like you can think of it as a very long-term diagonal in many ways.
Yeah, no, it's a great strategy. And once again, it's better, or what's best. It's do you understand what the trade-offs are, and how do you manage the risks and assess the risks of those trade-offs? So if you're buying long-term calls, 6 months or more, what you need to understand when you're selling calls in the short term against those long-term calls is your short gamma. And that's where I see most people with this strategy, the not understanding that if the market rallies in the short term, the long-term leap may at a point not make as much money as the short-term call is losing. And that's because of gamma. So what we try to do with the stock replacement strategy when you're adding calls is to never go, if you buy 10 leap calls, not to sell 10 front month calls against it. In the case of a large gap up, that's where you get hurt, is the large gap up, and gamma can destroy stock replacement covered call strategies if you have too much exposure on the short side in the short term. So going back to the XYZ example with the stock replacement, where you buy the bond and then you buy the call with the proceeds from the coupon of the bond. What if you were to sell a call against that? That's another way to enhance the income of that strategy. That Payne Weber came up with that in the 1970s. They called it their value fund. So you're long the bond market, you're long the stock market with the call option, the 80 delta call option, and where you get the blend extra little kicker is by selling a front month call against the long call. So I think it's a great strategy. It's a way to enhance the income of what's already gathering income from the bond coupon. If you're not using the bond component of it, it's a way to replace the dividend. So now you've got a stock replacement strategy by buying the call option leap, and your dividend replacement strategy is by selling the front month call option. The one thing to consider with that is that short gamma exposure in the front month on a gap higher. And the way to avoid that is if you buy 10 leap calls, you only sell 7 front month calls against it.
I like it. Bringing out the dark side of the Greeks, the gamma. I like it. Of course.
Yeah, you don't go down to the gamma pool very much.
Especially not on this show, because it tends to get a little people get a little terrified when we break out. When we crack open the door to Gamma's room, it gets a little scary. But you're right. That's a great tip.
I gave 4 people a heart attack at a conference when I brought in Roe. Like, that's the ultimate doomsday.
You did not mention Roe in a room full of people.
I've never mentioned Roe in a seminar or on a show until just now. But we didn't. We didn't really actually talk about it, so I'm not going to count it.
Roe, the forgotten Greek. That could be one of our shows. It'll be a very boring show, but we could do that show. But that is a great point. That's a great tip, actually, for a lot of our listeners. An easy way or a more effective way to try to overcome that gamma problem, because you're right. Gamma can bite you. If the underlying gaps up in the near term, that type of scenario, those near-term calls that you're writing are going to quickly overwhelm the long-term calls. So you need to have a plan for that. And doing that on some sort of ratio, a great way to put the odds a little bit more in your favor. All right, listeners, that's our quick rundown of a stock replacement strategy. If you'd like to learn more about that, then, of course, you can surf on over to theoptionsinsider.com. We have a lot of information on that and a lot of other great option strategies if you want to refresh yourself on any of the concepts we touched upon today, like Delta or Vega or even Gamma. Then, of course, check out archived episodes of this program as well. You can always call good old Mr. Mike Cavanaugh over there at RCM Wealth Advisors, or Randy and his team over there at Swan Wealth Advisors. They'd be happy to help you out as well over there at swanwealthadvisors.com. And, of course, can't forget our friends over there at the OIC. Check out optionseducation.org. And now it's time for my favorite portion of the program, because it gives you guys a chance to join us here on the Advisors Options panel. It is time for our listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, first up, we have a question here from Sal S, writing to us from sunny Fort Worth, Texas. He says, most of the firms where I house my client accounts are pretty worthless when it comes to options. I hear that a lot, Sal, so you're not alone. I feel for you. He says, rather than go through the hassle and paperwork of buying a put, what do you think about using an ETF like VXX to generate a volatility hedge for my portfolio? A great question, Sal. We get variations on this all the time. We've touched upon the VIX and the VIX ETPs, the exchange-traded products that exist around it, on many different shows on our network. On this one to a degree, but also on Options Bootcamp and, of course, on our Volatility Views program. If you want to learn more about that, listeners, I encourage you to check out those episodes as well. And it's actually an interesting timing on this question, because there's been a lot of interesting research and even some stuff in the mainstream, quote-unquote, financial media that has been touching on this exact topic. In fact, there was a great article in Barron's on the Barron's blog. I think it was this past week where they had some ETF managers coming in and realizing one of the downsides of a product like this. VXX, very popular product, one of the top exchange-traded products by volume on any given day. A lot of people, though, misuse it. They see it kind of what you're thinking of it here as this kind of longer-term way to put on a hedge to their portfolio. They want to hedge for a few months, or perhaps they think they have a longer-term view on volatility, and they want to use VXX as a proxy for that for a variety of reasons. Maybe they have a problem using options, or like you do, Sal, or some of the other issues people encounter. So they think VXX, they can wrap their heads around ETFs maybe a little bit easier than options, so they go that route. But the problem, there are a myriad problems with doing that. But basically, the fundamental problem with it is that VXX is not designed for that. People think it was, but it really isn't. So many problems with that. VXX, of course, they're hedging with the futures. It's a very short duration product. In fact, the typical holding period for the traders, the investors in that, investors in quotes, in VXX is only a day. So it's a very, very short-term product. It's kind of designed that way. Remember, it also rebalances every night. So this is an ETF that rebalances every day. So you have a lot of rebalancing going on, a lot of selling of near-term futures, buying of longer-term VIX futures. And if you know anything at all about VIX and the way the futures work, that's what's called roll risk. You're buying essentially, you're trading the term structure in kind of the wrong way. You're buying the very expensive stuff, which is farther out, that stuff has been bid up, and then selling the nearer term futures, which are, of course, at least in this environment, much cheaper. So you're doing yourself a disservice on a regular basis. Some estimates I've seen of the quantifiable danger of that roll risk can be up to 14% in a month. So if you're buying and holding VXX versus doing something like just buying the VIX futures or something like that, you're going to have to make up perhaps up to 14% in order to break even just on that trade. So long story short, I'm not a huge fan of using VXX for the scenario that you describe. If you want to take a near-term, 1 day or so quick flyer on volatility, or use it for a quick kicker if you think something's going to happen and you have a strong understanding of how VXX works, including all those issues I just laid out, then yeah, go ahead. You can use it and use it for some very short-term directional type trades. That's fine. But anything on a little bit longer term is going to be just I think a dubious way to use that product, and you're not going to be happy with the results. Mr. Kavanaugh, I'm guessing you guys get this question quite a bit over there from your clients. People see VIX and then they see things like VXX trading quite a bit, and they say, "Hey, put me in that one." Is that what they call you up about?
Yeah, and generally that's we get two types of phone calls. We get the talk me off the ledge conversation where, the market's down and whatever kind of day somebody's having, they get worried about something and they just need the confirmation that they're doing the right thing. That's probably the most popular call. The second type of the call is, I don't want to miss the boat call. And when you turn on the television or you have your friend at your country club talking about how much money he's making on the VIX, VXX, it's the I don't want to miss the boat call. So when they call in and say, "Hey, tell me about the VXX," I always come back with, "Tell me who told you they're using the VXX," or "Tell me why. Where did you hear about it? Give me some context," because everything you touched upon is so true. A lot of these products are made to be overly complicated, and the more you structure a product, the more layers. I always say the thicker a prospectus is, the more you should be concerned. They put warning labels on packs of cigarettes. The thicker a prospectus, it's like the FDA's version and the SEC's version of cigarette labels. If they've got an 82-page perspective and 81 of those pages are outlaying the redemption process and risks of an underlying that has 3 different components, and it's just not worth it. You trade the VIX futures. Read the prospectus. And I sent you a link to the prospectus. Read the prospectus and find out what they're doing and see if you can mimic it for the cost that wouldn't be anywhere near what you would pay in fees on not doing it yourself. And this one's not bad. The VXX, the investor fee is 89 basis points, which isn't horrible. That's just a fee. That's not talking about anything that you were talking about with relationship between the backwardation and contango of the option roll on a monthly basis. But for me, I kind of look at how do we break this down to get to the most purest sense of this product, and if I understand it, how do I do it? Most of the time, an investor then, after they've done that research, they come to the realization that they're not going to have time to manage it. And in some cases, it's worth to pay that 89 basis points to have the company manage it for you. But you should be able to come to that decision on your own without being sold on the concept. It's just asking the right questions. The first part of that is knowing the right questions to ask. And that's why, when you're watching the Super Bowl at the halftime with the commercial talking about the investment products, they always end it with, before you invest in this, talk with your financial advisor. Do that. You should call your financial advisor. And if you ask a question your financial advisor doesn't know, then find one that does. Keep asking. It doesn't mean you have to switch advisors. It just means find one that knows, because it's helpful. They'll be able to help you.
It is somewhat ironic when you think of it. People are much more terrified of doing something like buying a VIX future than they are buying an ETF with a prospectus that is 67 pages. It is somewhat contradictory. They think, because it's an ETF, I can wrap my head around it. It's simple. And the truth is, this is anything but a simple product. And the way it's executed, you can take fault with it, issue with it, whatever you want. That's kind of just the nature of the beast when you're doing a very short-term type product like this in the VIX. It's going to encounter these things like roll risk, and there aren't many ways to get around it. But you could, if you understand VIX and how it works, and volatility, how it works, and how the VIX futures work, most importantly, you could construct this yourself. And with the VIX futures, for a lot less money and for a lot less hassle, and probably have much better performance to do it. So that would be of course, Sal, it sounds like if your people who house your accounts aren't too good with options, I'm guessing they're probably not going to be that good with futures either. So I don't know if that's the ideal solution for you, but I certainly don't think VXX or most of the real the ETPs floating around VIX are probably the way to go. It might be worth, in this case, Sal, I think, actually going through the paperwork. And maybe once you do it once or twice, hopefully the people housing your accounts will say, wait a minute, this is actually of some value, and we can maybe improve this process for you in some way, shape, or form. Hopefully. Let us know how it works, Sal. We're very curious over here. All right, next up, we have a question from Avantage, and he writes an interesting one here. Do I need to fully understand the Black-Scholes formula to trade options? The Black-Scholes formula obviously being the pivotal formula that kind of birthed the entire options industry in many ways. Still very, very important to this day. That is, of course, where we derive a lot of these variables that we're talking about today, the risk metrics we all use, like delta, gamma, theta, vega, and Mr. Kavanaugh's favorite, rho. So in that sense, knowing how that formula works is unimportant to knowing how those variables work. But Mr. Kavanaugh, what do you say when people call you up and say, hey, do I need to know this? What's your take on, I don't think we've ever really discussed this before, you and I. What's your take really on the whole Black-Scholes and how pivotal it may or may not be, in your opinion, to overall options trading?
It's a great question. So here's what my answer to that is. We'll use an analogy between driving a car and becoming a Formula One race car driver. So would it make sense for me to understand every movement, capacity, how an engine works on a Formula One race car, how it corners, how every intimate detail about a car, if all I did is have a minivan with 3 kids and I just use a car to go to the grocery store? Probably wouldn't be that necessary. So is it going to help you with insomnia if you have sleeping problems and you're trading a couple options here and there and you just want to understand more? It's not going to hurt you to read it, but it is not the easiest read in the world. You have to know how to read an options book. I know that sounds weird to say, but you can't just pick up an options book and pretend to understand the derivations of derivations that they're talking about. There's complicated math formulas in any book that I've seen that explains Black-Scholes or Cox-Rubenstein formulas for that matter. So my answer to that is find a book that you understand that explains the pricing mechanisms. But to completely understand the Black-Scholes pricing model for options, I don't think is necessary unless you want to be a high-frequency, algorithmic, proprietary trading firm or hedge fund. I think you can get away with understanding the basic concepts of the Black-Scholes theory without actually having to be able to reverse engineer and do the actual math on it. if that makes any sense.
Oh, that makes perfect sense. I mean, if you know delta, if you know gamma, if you know theta, vega, and all the various other risk metrics that we derive from the Black-Scholes formula, knowing the actual equation itself and how to derive it and how to express it is not exactly going to be material to you. Like, let's say you're an advisor and you're looking to generate a little extra income for your clients. Is the in-depth knowledge of the Black-Scholes formula going to help you when you're writing covered calls? I mean, as long as you understand delta and vega, and in that scenario, theta and gamma, then you're definitely going to benefit from knowing those. Whether or not you can derive the formula itself, not exactly a pressing concern. So, Mr. Avantage, if you wanted to spend the time and learn it, it certainly wouldn't hurt you. It would give you a much better understanding of kind of where we've come from and how the models have evolved, how our understanding of options has evolved over time. That would certainly be a beneficial thing to learn. But if you're a busy advisor and you're having a hard time right now just wrapping your head around these options things, and you got your handle on delta and gamma, theta, vega, and all that stuff, then maybe diving into the derivations of the formula itself and the different metrics and variables, not necessary for you to understand enough to understand options and to benefit your clients. All right, and last up, a bit of a mechanics question, logistical question here from Mr. Nick Thomas. He writes, how long do I have after the close of trading on expiration Friday to decide whether to exercise my client's call options? Also, do you have any good rules of thumb when deciding whether or not to exercise? Well, we'll start off a couple pieces to this one. We'll take them one at a time. First off, when you're deciding whether or not to exercise your calls, they've changed this up quite a bit. It used to be a much larger automatic exercise threshold for your clients, and so or for you. It used to be a nickel or more. Now, if your clients' calls are in the money by even a penny, they're going to be automatically exercised. So if your options are in the money, don't worry about it. If you want them to be exercised, they will be. The only time you have to contact them is if for some reason you don't want that call to be exercised. You don't have the capital in your account to buy the underlying or whatever the case may be. But that's the case. You probably should have sold that option earlier. But that's a conversation for another day. So if you're long and you don't have them be exercised automatically, you don't have to do anything. If you want to contact them to say stop, don't exercise them automatically for whatever reason, then you have to reach out to them. This has been complicated too by the fact that expiration Friday is now every Friday. It used to be once a month. This issue would arise and it'd be a little bit of consternation on expiration Friday. And now it wouldn't be that big of a deal because it was only once a month. Now it's every week. So this problem rears its head every week, time and again. So it is much more of an issue to figure it out. They have recently tweaked the way they handle the late exercise. They just updated the time. Am I correct, Mr. Kavanaugh? Didn't they just tweak that over at OCC?
I believe so. I'm not 100%. I think I did. I do remember hearing something about that. I deal so little with assignment issues anymore. I mean, it's very rarely do we ever get caught with a position close to expiration. I want to say yes, though, for some reason, because I had an issue with the client about 3 months ago, and I think they did bump the time. It was Saturday morning, right? In the past, now I think they do it on Friday night.
Yeah, now they do it on Friday, and I'm trying to find the exact time.
I think it might be 7 p.m. Eastern. I don't know why that time, but yes, I'm pretty sure they changed the time. I could figure it out, but it's like one of those things.
Yeah,
you know what you know.
You never need to use this. You don't have to dig up the exact time.
Right.
But yes, the moral of the story, Mr. Thomas, is, at least in the first part of your question, you need to contact your broker, your custodian, whoever is handling your options accounts. Ideally, right after the close, if you have some contrary instructions you want to give them. If you want to say, don't exercise these, then you need to, tell them, or the sooner the better, within an hour or two of closing, definitely you want to have those instructions in. The other scenario you're thinking of is, well, let's see, I have these calls, and maybe let's say XYZ, you have the 100 strike calls. They're expiring today. This is expiration Friday. XYZ closes at $99.99. But guess what? There's earnings after the close. So now you hold on to these and you see the stock all of a sudden gaps up to 105 in the after hours. Guess what? Those 100 calls are now $5 in the money. You want that. So you need to contact your broker again within that few hours of trading and say, hey, give them those contrary instructions. These things that are actually not a penny out of the money that are worthless, you will never exercise. I actually want to exercise them. And I want to buy the stock for 100, even though it says the stock closed at 99.99, there still is that window of the after hours that you need to be cognizant of, particularly in environments like earnings, or let's say some sort of guidance call, or let's say a biotech having an announcement of the FDA, whatever the case may be. If something's going to move the stock in the after hours, you need to be cognizant of that, because at the end of the day, you can actually be benefited or harmed by that activity in the after hours, even if the stock closed and your options are out of the money when the stock closed. That's also important to remember if you're short, if you're writing, let's say, naked calls, and for whatever reason, or even covered calls, and you sell those 100 strike calls again, same scenario, and the stock closes at 99.99, you think, oh, I'm safe, my stocks went out. My options went out worthless. I'm good. Then there's earnings in the after hours. Stock pops up. Those calls are going to be assigned against you. If you have the stock, you'll be all right. But if you're just naked, all of a sudden you're going to be short tons of shares of the underlying come Monday morning, and you probably weren't expecting that. So that's not a surprise you want to have greeting you on Monday morning. So that's, again, that goes back to things we said on the show many times. If you have positions, particularly short positions going into expiration, and they're going your way or they're getting close, and you have questions about them, just close them out. It just saves yourself a world of headache. Even on the long side, close them out. Then you don't have to deal with this after-hour stuff that a lot of people get so worked up about. The second part of your question, do you have any good rules of thumb when deciding whether or not to exercise? There are a couple. There's one very, very easy one, and that is, of course, remember, we've talked on the show in the past about dividends and what happens. Underlying holders get dividends. Options holders do not. So we talked about dividend plays and some aspects of those in the past on this program. There's a very, very simple rule of thumb to do that if you want to decide whether or not you want to exercise your call. Remember, 99.9% of the time, it is disadvantageous to exercise a call early. You never want to do that. You always want to sell that call as opposed to exercising it, because when you exercise, you're giving up all of that time premium and everything else that you have with that call that you would gain by actually selling it. So you never want to do this early. But a quick rule of thumb for doing this, because we're getting long on time here, I mean to wrap this up, is essentially look at the value of that put. If the dividend you're looking to collect, which is, of course, the only reason you want to exercise this call early, if the dividend you're looking to collect, let's say the put's trading for 80 cents and the dividend's $2, then yeah, you want to exercise that call, because the amount you're collecting in the dividend is going to offset what you're losing in the extrinsic value of that option, the put value. So that's a great simple rule of thumb, Mr. Thomas, to use when you're gauging whether or not you want to exercise a call early. And that's a great question. Unfortunately, that's all the time we have for this episode of the Advisor's Option. I want to, of course, thank Randy and the folks over at Swan who couldn't make it today, as well as Eric and Alan, the folks over at OIC, who also couldn't join us. But because you're here, Mr. Kavanaugh, what's cooking in the land of RCM you want to let our listeners know about?
Oh, there's so much cooking. We've got a managed futures and alternatives strategy seminar in Louisville coming up December 10th. We've got 4 great panelists, 4 great emerging money managers in the futures and managed futures space. Very much looking forward to that. And then just the average day-to-day, rumblings over here at RCM. Check out our website, www.rcmfs.com. We've got about 4 or 5 things on a weekly basis going on between our Thursday night trading webinars and just different, videos and the different commentaries that we're sending out. Check it out. You can sign up for newsletters, webinars anytime, and we're growing. The next generation of financial services has been working for us. We're basically helping companies, people in both the futures and equity world that have been overlooked the last several years, and just helping them decipher the different types of investment choices they have, and helping them build their portfolios tailored to what they're looking for, rather than just getting stuck in target date funds and products that they don't understand, and where the only people that seem to make any money are the people that are selling it. So we've grown over 600% in AUM year over year here at RCM, and it's exciting. And if you're in Louisville December 10th, let us know, and you can stop by and have a cocktail with us as we learn more about managed futures.
You're the Pepsi of financial services. You're the choice for a new generation. Is that what you're
That's
telling me?
right. We're going to change it to RCM Pepsi.
I like
It's going
it.
to be our name.
I like it. Might have a
Next
few
generation.
lawyers knocking on your door, but other than that, it sounds good. I like it. All right. Thank you for that, Mr. Kavanaugh. Of course, on behalf of Mike and Eric and Alan and Randy and all the rest of the Advisors Option crew, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and, of course, for writing with such great questions. Keep it up. You guys are really knocking it out of the park. And we'll see you next time right here on the Advisors Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.